Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Welcome to LiveSquawk's Market Talk, our weekly review. This is on Friday, the 9th of January, 2026. Happy New Year to you all. For anyone new to this podcast, every week, myself and guests break down the key stories of the week gone and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up to what you should be looking out for. At this episode, I'm joined by regular contributor Sam Cutler, portfolio manager at 333 Capital, and Mike Zaccardi, a financial writer, storyteller, and teacher, and he writes on investments and market analysis, amongst other things. There's a few bits and pieces to go through today, but it's on the whole, I think for market volatility itself, I don't think it's been particularly busy. We'll get into all that in a minute, but before I bring you my two guests in, just a quick disclaimer here. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. So welcome to my two guests. Hello, Mike. Hello, Sam.
Hey, Harry.
Good morning.
And this is as I said before, this is my final Happy New Year to people. From now on, we're into the new year and it's done. So call me a curmudgeon if you like. But I want to get on to this week's data. We've recently, about an hour ago now, had the latest US non-farm payroll report, which showed an additional 50,000 jobs were added in December. However, the stories in the unemployment rate and the revisions, both for last month and last year. So, Mike, I'll bring you in first on this. What are your initial views on what we've just seen from the Bureau of Labor Statistics?
Yeah, kind of more of the same. We're still in that slow hire, slow fire labor market. There are indicators that the jobs market may have troughed right around the government shutdown here in the States. We had some mixed data this week. In general, I think it was somewhat encouraging. The Revelio number was the best in several months. ADP was positive, especially it was actually positive across all business sizes. Claims remain low. Challenger job cuts were the lowest in about 16 months or so. It looks like certainly the labor market is not falling off a cliff. We had the unemployment rate fall 16 basis points in December from above 4.5, which rounded up to 4.6 in the November report, to rounding down to 4.4 this time. And we're going to get more commentary from CEOs starting next week. We get Q4 earnings rolling in from the banks. It'll also be a pretty active time on the conference circuits. Industry-wise, one of the biggest events of the year, the JP Morgan Healthcare Conference, kicks off, following CES this week. So we're back in the full swing of things after the holiday break and after the government shutdown. We'll get CPI retail sales next week as well. So no surprises. There wasn't, I think, anything that really jumped out in the December payrolls report. Really just kind of more of the same.
So you weren't. I'm reading reports here that people were more interested in, like you say, in the unemployment rate, which ticked down, but also the revisions that showed, or maybe belied, not such a weak labour market relatively as people would have thought, and really just rules out. Not, I think there was a major call for a January move, but rules out any near-term move from the FOMC. You didn't see anything in that back data then that gave cause for concern or elation then generally.
Right. Yeah, we're down to a 5% chance of a January cut. We'll get plenty of data between now and the 28th when the Fed issues this decision. But yeah, barring a shocker next week with CPI and retail sales, we should be pretty firmed up here with the Fed being on hold in January.
Yeah, good chat. Sam, anything to add on that?
I mean, yeah, a few things. I mean, I look at some of my models, and it's, pretty conducive to what Mike was saying. It looks like the U.S. labor market kind of troughed in August. We have some of the worst labor market metrics, on the whole coming through in August, and we've slowly recovered since then. But we're still kind of flatlining, and the trend to me in labor is still very weak. Even if I look at, get into the nitty-gritty details of this release. I mean, I think it was a little softer, and you know me, these headlines. I hate the headline numbers, and I think they're always, very, very deceiving.
You're a details man. You're a details.
Yes. we got that 50K, right? The consensus was 70K, and I think the Bloomberg Whisper number had slowly crept up. And like Mike said, that was on the back of decent ADP numbers. The Revelio Labs numbers looked pretty good. But if you also look at the revisions, right, the last two prints revised down by about 76K. Yes, UR fell, but we also had the labor force falling, and there's some little intricate details in there that I found interesting. But on the jobs numbers, I mean, the gains were mostly, again, in the non-cyclical sectors, right? The government added 13,000 jobs, education and healthcare added 41,000. That was mostly all on the healthcare side. Leisure was the only cyclical sector with any kind of real momentum. That was up, I believe the number was 47,000. And that really just basically recovered, some of the last month losses on that. Apart from leisure, cyclicals still net on net lost jobs, down about 4K. And that's the third straight month of contraction on that front. And if you look at the UR rate, right, that kind of dropped on the household survey gains and, of course, the lower participation rate. But what was interesting is the participation rate declined from native workers, which is pretty unusual for December. So I kind of take that as a little added sign of weakness. And we also saw temporary help metrics fall again, and those have been trending down for a few months now. To me, hours worked still remain pretty weak. On a non-seasonally adjusted basis, payrolls actually printed near historic lows. So total job creation for 2025 is only 537,000 versus the pre-pandemic norm of around like 2.3 million. So I think kind of bottom line here is the UR metric makes headline look a little better, but I think trends are still soft, and the labor market is cooling. It's not breaking, but it's cooling, and I'm not seeing any real signs of reacceleration at the moment.
Okay, just a quick note. I've got a note here from this is from the Peterson Institute for International Economics. In a post, this was from Jed Kolko, saying that that's the slowest annual growth outside of recessions. Immigration policy slowed workforce growth, which has held back job growth. We'll get on to geopolitical stuff because I think that's the juiciest part of this week's one. We did see Eurozone inflation data, flash reading, coming around target, keeping ECB on hold for now. There's not a great deal of story in the European picture at the moment, outside of maybe the German investment, which is going to be over a number of years, but nothing likely to stoke inflation near term. And ECB officials generally are looking to be on hold for this year, with, again, speculation we could see the next move in European rates on the upside. So it's one to watch there. Let's get on to the big story this week, really, in the first full week back, which is the Venezuela story. For anyone who's been asleep for the last week and a half, US basically, I guess there was an incursion into Venezuela. They took out its leader Maduro. When I say took him out, and his wife, brought them to America, arrested them, taken them to the US, and have since appeared in court. The big connotations around this are what it does to the oil market. Venezuela has the largest reserves of oil in the world, and the US is now going to take that over, or US companies will now take that over and start to restart that infrastructure. Mike, have you been across this story? What do you make of it?
Yeah, it seems like we're 2 for 2 on these regime changes and attacks on overseas assets. Recall that stocks soared in May when we lit up the Iranian nuclear facilities. So yeah, I mean, this one, another kind of stealthy move that markets seem to give the thumbs up to. Oil has been, it's been wobbly, but it's generally between 55, 60 NWTI, add about $3 on that to Brent, and not a whole lot of action there either.
No, it happened over the weekend, so I guess the markets are a little bit sleepy on that front. But like you say, there's not been the kind of reaction maybe some would have feared or hoped for, maybe since then, since we've been back to work.
Yeah. I mean, we see that in equity volatility too. The VIX is pretty low. So, I mean, fundamentally with this, it's, you have the geopolitical piece of this. How are other nations going to take to the Trump doctrine of being very aggressive on some of these international maneuvers? And what happens next when it comes to areas like Greenland, which prediction markets are seeing higher chances now of the U.S. Potentially annexing part or all of that country. So definitely going to make for some macro fireworks as the year goes on in the midterm election year. But financial markets are often the first arbiter of how these things really are perceived. And yes, we've seen rallies in the precious metals, but that's been a story that began long before President Trump even resumed office last year. So if you were just to ignore the headlines and look at price action alone, you wouldn't even know really anything happened. So it makes for a good media narrative and geopolitical fodder. But from my perspective as someone who looks at charts quite a bit, there's not a whole lot of fireworks to this. I mean, it's almost become, investors and traders see the data. They see that whenever these sort of geopolitical events take place, there may be near-term volatility, but ultimately they don't generally change the long-term trend. And in the last two instances, we haven't even seen much of a dip to buy. It's just been kind of a bullish reaction all the way around. So yeah, we'll see how it unfolds in terms of the next domino to go. It seems like Trump is certainly, having his eye on assets around the world and land areas to acquire. And I don't think we're going to see a whole lot of volatility until some major player really steps up to challenge that. And that could happen, but the market's not suggesting we're going to see a whole lot of fear around that.
Sure, well, he's definitely in the mood at the moment, isn't he? For a president who was looking inwards, he's very much now looking at the global situation, I guess, at the moment, and picking his fights, shall we say. Sam, from a trader's perspective, from an investor's perspective, how do you square up to all this?
Yeah, I mean, from a geopolitical standpoint, I don't really have too much to add there. I don't really fancy myself an expert in that area. The only thing I try to think of from a trading standpoint too is, what are the goals here? And I think, Trump's move on Venezuela, where they're taking like 30 to 50 million barrels or something. I think that's kind of like his goal might be to just like reroute the oil cargo that was originally destined for China to the US, right? I don't think that has crazy implications. Like, I think everyone, they came in expecting, oil to just get destroyed on this. And I don't really think, I didn't really see that through. I was hoping to, that there'd be some spots that you could get kind of long some oil, if it ever came down to around that, $52, $53 a barrel area. I think that's a fantastic buying opportunity, but unfortunately it never did. And other than that, I kind of agree with what Mike said. And as far as, volatility goes on Trump, Trump is, it's kind of like the human VVIX, right? So I think at some point all this stuff is going to lead again to volatility. But it's just like he said, it has to be more than just talk, especially when you're speaking on the Greenland front. There's going to need to be something that actually happens. And I don't know if that's just a lot of talk or if it's actually something he's going to aggressively pursue. And I think time's just going to have to tell for that.
Well, yeah, just a couple of points. We'll come back to the Greenland bit in a second. But Trump is apparently set to meet top execs from big US oil firms today. But again, there's a bit of caution amongst those executives about whether they want to step their toe into the water with things still very much up in the air, and do they want to invest billions into Venezuela and utilizing their reserves as well as extraction, if we get this political to-in and throw-in at the moment. So it's not as straightforward as people may think. Therefore, like you say, the oil prices haven't really moved in any great swaves one way or the other on the back of that. On the Greenland story, look, 6 months ago he was saying he would wanted to buy Greenland, and now he's looking to take it by force. Again, from a military perspective, it's not the hardest thing to do. Apparently, I'm no expert on the military side either, but from what I've read, again, it's going to be met with resistance. You say resistance from within US NATO members, US NATO colleagues and partners. So again, it's one we have to watch, and could be a lot of talk, but you have to be aware when Trump is on, like we say, he's on a mission, because something tends to happen. So we'll keep an eye on that. Talking of President Trump and him being on a mission, we're likely to get a decision or not. I mean, I'm looking at different reports here that suggest that we may get nothing today, but I'm talking about the Supreme Court, the IEEPA tariff ruling, a key decision on legality of duties and tariffs that we may see come through today. Mike, I know you and I were just having a little bit of a chat about this beforehand. 10 o'clock Eastern time is the earliest it can come. Where are we now? What's the time here now? We're coming up to 10 o'clock Eastern time. And I've got a note from Wells Fargo, which if I can find would be helpful. And it just suggested that there's a number of different ways this could go. One of them being that we may see nothing at all from it. Let me just get this up now. So it says, Supreme Court, we expect a decision on the IEEPA tariffs today, 10 a.m., given how the court has expedited the case so far. But one is not guaranteed. One, because SCOTUS announced on Friday in September as a non-argument day, meaning the court will meet for a session in the courtroom at 10 a.m. where they announce opinions or decisions on cases. The court does not, however, announce which rulings will be released ahead of time. Mike, it's a hard to if, buts and maybes, but how do you view this Supreme Court ruling?
Yeah, I mean, once again, we're not seeing a lot of volatility priced into markets with this. I mean, it's also possible that the SCOTUS grants some kind of stay on this, maybe 6 months or so, to where the administration can keep collecting tariff revenue, but afterward it will no longer be allowed. And then even at that point, the administration has alternative routes aside from the IEEPA tariffs. They can take the Section 232, 301, 122. It's like pick a number on these various scenarios and pass that the administration can take on collecting tariffs. So I think we're still going to see a significant amount of tariffs being collected, but companies have already been able to plan for this. And if you look at the aggregate number compared to the total amount of tax receipts for corporations, it's not an extreme level. And taking everything together, I suspect we'll see a marginally lower effective tariff rate this year compared to last year, as further deals are made, and this acts as a bit of a pushback towards tariffs if the SCOTUS indeed rules against them. And while tariffs are maybe the ultimate hallmark of the Trump administration in a second term, they may take that as a sign to back off somewhat on this and focus on other issues, certainly ahead of the midterms, and then in Trump's final 2 years. So yeah, I was just looking at some volatility pricing data ahead of today. The one-day VIX was only about 13 or so, and that's on a jobs day, which is a very low number. And the traditional VIX right now is pretty tame, 14, 15, or a little above that. So once again, not expecting a ton of volatility around this, and it's hard to say when, like you said, the actual decision will be made, but markets seem in a good spot ahead of it.
Yeah. Again, just looking from a monetary policy perspective as well, I think a study by one of the Fed banks this week I read suggested that again the hit on inflation from tariffs is manageable and fairly limited in scale, really, to the CPI on the whole. Sam, same question again as I asked you about the Venezuela situation. Do you take any of this into account? Do you, I don't know, protect yourself against it as an investor? How do you look at this?
Yeah, I think you have the hard part about this is not knowing when it's going to come, right? I think, if you're talking on this tariff front, I think virtually everyone thinks, that some tariffs are going to get repealed. But I think the main, the main event on this is going to be what happens around refunds, right? Are the governments going to be allowed to keep certain existing ones in place? Are they going to have to refund? I think that's where the situation gets messy. And it's one of those things, I don't think you can predict it very well, especially, like you guys said, it's the opinion day where they're just giving their, letting out some things on certain cases. Now it's just assumed that the tariff case is going to be one that's discussed. But again, there's absolutely no guarantee of it. If you look at like I remember briefly talking there about polymarket odds, right? Like if you look at there's a couple ones on it right now, and the probability is like 33% in favor of the Trump tariffs.
Oh, in favor.
And in favor of them, yes, correct. Okay. So, again, like for me, from an investor standpoint, I'm not really making any decisions based on this, right? Like I have, I always have hedges in place, especially when Trump's in office, as that just in case. The guy's a guy that likes to talk, but again, when you have random headlines like these coming out that you can't really time, you just kind of got to be aware that they're coming out and kind of look at your book, look at correlations, how your position's correlated. Do you have enough offsetting positions, kind of stuff like that. I think that's the best kind of advice I could give on that front.
Okay. Just a note, again, this is from the Wells Fargo report. It says on the refunds, it's entirely possible that court kicks the decision on refunds to the lower court to decide. But even if the court decides Friday that refunds must be made nationwide, it may require individual importers and businesses who brought the case to file a case to get the refund, lengthening the process anyway. And says the bottom line is that refunds will take time to pass through the system. Friday may not bring an exact timeline. And if processed in full, somewhere around $130 billion in refunds would gradually make their way back into the private sector. And this covers just about over half the tariff revenue generated over the past year, or about 3% of total federal revenue generated in calendar year 2025. Okay, so again, uncertainty, but again, no undue worries really within the markets on that front. Looking now towards the week ahead, and if I can bring up the right one, which I didn't, we'll look at that. So basically, we're looking, I think headlining next week is the US inflation report. Mike, we're not really looking for anything too outlandish from the inflation number, are we?
No, I don't think so, but we will get a little bit of a catch up from all those imputed zero numbers from the November, that October-November November report. So it may put upward pressure on the actual December month-on-month numbers, but the market's going to look through that. They know that those are coming. So, we could see like a 0.3% uptick on headline and core, ticking up. The year-over-year rate should still be below 3%. But the numbers on the surface may look hot, but that's just all kind of catch up from the missed numbers from last fall. So,
Sure.
with traders pretty firmed up on no Fed cut and, pretty tame energy prices in the last month, the headline number otherwise won't be too astronomical, but there will be some catch up there.
Okay, cool. Sam, any views on CPI?
Yeah, there's definitely some nitty gritty details in this, and it has my mind wondering on a few fronts, right? So, I can still kind of argue the case that inflation, you could continue to see it be stubbornly sticky this year on kind of delayed tariff effects still. I'm not 100% sold on that, but I can argue certain points on that. Like we have seen, the short end inflation swaps, like Mike said, and break evens experience, a really large drop. A lot of that is attributed to the recent drop in gasoline prices. With the short end of inflation swaps, those really move on kind of those short-term energy prices. But honestly, man, with what the BLS did in October, it really, I'm not going to lie, it creates garbage numbers, right? So you have to assume because of what they did, just kind of netting out some of those things, that the year-over-year data for the next little while, it's going to be artificially low. And the problem with that is the BLS never adjusts the NSA data ex post. So if it's wrong, it's going to stay wrong.
NSA being non-seasonally adjusted data.
Yeah, so then my mind gets rolling way in the future, right? This isn't either here, there, or now, right? But this also means you have to think about what happens to next year's seasonal adjustment for the month of October. So it could create kind of a massively upward bias for that point. But, basically, for those that don't know, the intricacies of what the BLS did here, basically what they did was not calculate the 2-month change based on the current price level. So this is also going to have big repercussions for the housing metrics, right? Because they basically assumed October's change was 0. So instead of a 2-month change, you got a 1-month change spread over 2 months. So this whole thing on core services, right, dropping from 3.5% year over year to 3%, it's just impossible to believe that that's anywhere close to true, right? So coming up to this week's inflation report, I think, like Mike said, there's a solid chance that this does surprise to the upside. Now, for core, I'm more in the 40 bips camp, month over month, and this is just because of the mechanical upside for December because of what the BLS did. You like you said, you can expect some payback in December. I expect you see some in January as well. And the reason for this being extremely mechanical is you have bi-monthly sampling catch up, right? So August, October, December. These are where, bid sets of items get repriced in the BLS, but they have essentially just carried forward the August price levels. So these series are going to reprice in December. So the index isn't just going to capture, kind of that usual small October to December move. It's going to actually capture the cumulative August till December change. And that's just going to be much more, mechanically larger. So I think that alone has the possibility to add 10 bips to the month over month on core. So a perfect example of this lies in airfare, right? Prices in airfare typically rise 5% August through October. And that essentially was missing in October. So that's going to reappear in December. And you also have to think about the shutdown and how this affected the November price collection data, right? So you had Black Friday discounts. Those are going to be amplified due to the collection period that seasonal adjustments don't offset, because they began on what I think the collection period was November 14th. So you're going to have much more quotes during holiday sales, which kind of exaggerate the seasonal price decline. So I think there's some risks there. And, if this does come to fruition, you're going to see it in those categories like apparel, household furnishings, and recreation goods, and probably similar things to hotels as well.
Okay, interesting. Good to know. We have retail sales also out. So again, just going back to part of what you were talking about just there. Again, the US households have been resilient. The US consumer has been fairly resilient over the course of 2025. But there are volatile sectors within there, and we'll have to look at apparel on that front to see where that impacts the number as well. We'll move across the Atlantic now as we're coming to the end of the show. UK GDP. Nothing really big to look at here because the UK economy is fairly moribund at the moment, and we're not seeing a lot of activity, and we're not expecting a lot of activity really into 2026 or the early part. I think general consensus is we're looking at a fairly soft read. I think consensus is looking for flat to, I think, small down here for the month of November. This is obviously backward looking. But again, people will look for signs of momentum, and really there isn't a great deal. A note from HSBC here says UK GDP fell in October amid pre-budget nerves and uncertainty, and surveys showed little improvement in November. Even the small rise we see, led by distribution services, which saw sizable falls in October, still leaves GDP down 0.2% on a three-month basis, and we now see a slight contraction of 0.1% for Q1 as a whole, though the economy should perk up a bit from January onwards. So just a note there. We got China December trade balance next week as well. That could be of interest. Just see about the global demand aspects. Mike, do you anything interesting on this, or is it just something you'll pay mind to as and when it hits?
Yeah, we'll just take that one time as it comes. I don't think it'll have too much of an impact.
Cool. And then really, geopolitical risks are still very much there, but as we've discussed, at the moment, that again, the volatility index and the risks around the geopolitical picture are fairly benign for the time being until we get just a bit more clarity as to what we're likely to see, really. And if we are, the market, as you both said, market seems to be taking it in hand at the moment and not jumping to massive conclusions one way or the other. But there's definitely a geopolitical risks. I want to round off with just quickly your general views on 2026 and where you see, just if you want to pick one or two areas of either concern or optimism for the financial market environment in its entirety. Really, I know it's a big question to ask at the end. So, Mike, what are you looking at? Anything in particular at the start of this year within the bank forecast that you may have read, or anything you've seen so far?
Yeah, I think just taking a step back, we have to be mindful that it is a midterm year, which tend to be more volatile than the other three election cycle years. And, it's possible that we do get more. I mean, I think we will certainly get more headlines around the election and potential policies ahead of that. It's clear that the Trump administration is trying to juice things up here with, the announcement of potentially calling for the purchase of mortgage-backed securities to lower mortgage rates. So more of that. Technically, we had a bullish first 5 days of the year indicator, which is actually historically pretty reliable. So the S&P was up 1% over the first 5 trading days of the year, which bodes well. And broader, from a broader perspective, we've got equities trending higher, all-time highs across markets, both U.S., abroad, small cap, large cap. So breadth is very strong. I wrote an article about that earlier this week on stockcharts.com, just broadening everywhere. And all the while, we've got treasury yields pretty tame. I think we do have to watch out for if the 10-year gets above 4.2 for the wrong reasons. That could bring about some Q1 volatility. We're very close to that right now. But the trend of larger degree is higher. And if it were just a handful of stocks driving things, that would be one thing. But we've got global participation, which looks fairly bullish to me.
Okay, interesting. Sam?
Yeah, I mean, this is something I could go on for hours and hours about, but
Please,
I think
we've only got a couple of minutes left.
I think the main theme to start this year for Q1 is kind of a broadening of the equity rally, right? Not so much concentration in infotech, expecting kind of materials, industrials to kind of lead the way as economic strength and the one big beautiful bill stimulus kicks in. So I think the first half of the year is going to be extremely bullish. Because tax refunds, the stimulus that are going to be drivers, so you kind of have a tendency to see data surprise to the upside in the first half of the year. So data should continue to optically beat for the first half of the year. Now the question for me is what happens in late Q2, early Q3? Are we going to see some type of growth deterioration because the labor market continues to cool, and that's still a concern of mine here. So.
Okay, nice and succinct. Thank you very much. Just note, this is a note from Morgan Stanley, just to round this off here. And they've written a research piece on the economic outlook and investment strategy for the next 12 months. They focus on the US economy as well as global markets and the asset class performance. But just note, they say the US economy showed strength in Q3 of last year, but signs of a modest slowdown are emerging, influenced by government shutdowns and tariffs. Corporate profits indicate that tariffs are being passed to consumers, potentially softening real consumption as prices rise. And they say a short-lived slowdown is expected, supported by a fiscal expansion and monetary policy adjustments, with Fed Reserve rate cuts anticipated sooner than market expectations. They pinned January and April of this year, controversial. The Fed's data dependency is increasing as it approaches a neutral policy stance, with upcoming payroll and inflation data critical for future decisions, and saying the first half of 2026 will clarify the US economic trajectory, impacting global markets. So just a little snippet there of what they see. I could go on because they talk about Japan as well, but that's for another episode. Listen, I'd like to thank my two guests, Mike Zaccardi. Thank you very much for your words today, and also to Sam Cutler of 333 Capital Markets. Thank you.
Yeah, of course, Sarah. Always fun to catch up.
Brilliant stuff. And I'd like to thank everyone that's listening to this. If you've missed the start of this show, you can go back and you can access it on Spotify, Apple, iTunes, Amazon Music, as well as other platforms, or YouTube or X if you want to go back and listen to it on that. I'll have another episode next week for you. Listen, I said I wouldn't say it again, but I will say it one more last time. Happy New Year to you all, and hopefully it's a prosperous, healthy new year for everyone. So thank you for listening, and goodbye.
Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.